Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Marketfy. I'm your co-host Joel Alcon, along with Dennis Dick, and we have JC Parets on the line, and he's the founder of Eagle Bay Capital. And pretty good day to have JC on. We got a lot of movements in the markets. JC, how you doing?
I'm doing great this morning. How's everyone going? How's everyone doing?
Pretty good, pretty good. Let's just start out with one of your targets in a big stock, Apple, and that hit your target yesterday. Now, when a stock hits your target, I mean, are you just out? Do you just like get out of your positions and say, okay, enough is enough, and wait for an entry to rebuy, or is it just kind of like a warning sign to say, okay, we've hit our target. I'm going to be careful, maybe move my stop up.
No, when it hits the target, we're out. We're very disciplined. For me, I don't care whether we're trading shares of Apple or gold or, Indonesia or treasury bonds. To me, it's just math. I really don't care if we're buying it or shorting it. It doesn't matter to me at all. For me, it's really just a risk reward. And for us, Apple, like we said last week on the show, we only wanted to be long Apple above the November highs, call it, just below 119, something like that. Below that, all bets are off. We did not want to be long. Now, with that said, we had 10 points to the upside, target of 129 for multiple reasons that we went over. And sure enough, we got there. So that risk reward, we had essentially a 20-to-1 risk reward for all intents and purposes. And target hit. So on to the next one.
JC, when you're putting on a trade, do you always put a target ahead of the trade? Like, do you have like a whole contingency plan and a setup, like all set up before you put the trade on?
Of course, if you don't have a target, right, then there's no way to calculate the risk versus reward, right? Because if you don't have a target, you can't calculate the reward. So you need to calculate your risk. Where am I out? Where am I wrong? And calculate your reward. Where do I think it's going to go? And then you come up with that ratio, and then let's say it's 6-to-1, 8-to-1, 12-to-1, whatever it is. And then once you calculate that, then you need to decide personally. I can't tell you that for you. You have to decide personally if that particular risk reward meets your goals and your objectives, your time horizons. We're all different. For me, I look at a 10-to-1, 15-to-1 risk reward in Apple above 119 with a target of 129. I'll take that trade all day.
So do you give yourself some wiggle room on that? Because I see it only hit 878 with 871 close. If something gets within 50 cents of your target or whatever, and it's on the close or whatever, you're not going to haggle over another 50 cents, right?
We're not going to fight for pennies when we're trying to make dollars. You know what I mean?
Yeah, that's a great point. Sometimes traders can be too firm on their targets. Well, oil's had a rally. It's given some of it back. This $50 level could be a magnet for a while. What stocks are you watching in the oil patch?
I'm not really too worried about it. I know the media loves it because, it's great clickbait and, the audience loves to watch it on TV and, everyone's an oil expert all of a sudden. There's just easier trades. I mean, oil's a mess. It's a crashing market. Everyone's obsessed with it. Let them waste their time. Let them lose their money. It's a chop fest. I hope it makes new lows. I hope all of these, longs, the last bulls, I hope they get crushed. Let price make one more low. I think selfishly, for me, if we get that one more low, I really don't think that momentum will be able to confirm that and essentially momentum make even lower lows than it did on the fresh lows of the last couple of months. So selfishly, I think that a new low in price would put in, some kind of bullish momentum divergence, which ultimately could give me an entry point. So yeah, I hope all these bulls and everybody who bought it gets crushed and we make another low. I think that would be the perfect entry point, in my opinion. We make a new low, momentum diverges on a bullish note, puts in a higher low, and then prices recover back above the January lows. That's your entry. My perfect roadmap would be that. Until then, there's easier trades, and I'm not really too worried about it.
It's a great point you're making because a lot of times you see, where there's a very obvious bottom and people are picking off of that bottom, that a lot of times the market will take it through that bottom, maybe by a point or two, just to shake out those people who are leaning on that, and then eventually, or then immediately rally it back up to catch anybody who's maybe shorting through that breakdown there too. And those are some of the best trades. And actually, JC, I don't know if you saw this one, but I was looking at First Solar trading yesterday, FLSLR, and this is kind of the opposite theme, but for 4 days, the stock was struggling to get through 50. And then yesterday on the open, it took out $50, ran all the way up to 50.79, but then crashed right back through it there again. So I bet you caught a few people maybe playing the breakout there. I usually like to call those breakout trades fake outs. And I think that's what happened in First Solar there yesterday. So just quickly, what are your thoughts technically on First Solar here now that it kind of had a failed breakout there yesterday?
Yeah, well, remember this is support from October, so the market has a lot of memory here. Not only was it supported in October, it was supported in November, and then when it broke, kind of retested it at the end of November. There's a lot of market memory here, so I really, and we're in a downtrend, a very vicious downtrend. I mean, this is one of the worst one of the worst stocks in the world for sure over the last several months. So we shouldn't be surprised. Momentum's still in a bearish range. The long-term trend is terrible. I see no reason to be in this.
In the same sector there, SunEdison too, and I also just want to talk to you about like the filings. I'm pretty sure I know what your answer is going to be, but like when Warren Buffett gets out of an Exxon Mobil or someone piles into a SunEdison, that doesn't affect your trading or thinking? Maybe look to fade those kind of moves, or what's your take on that?
Well, remember, by the time it's reported, it's already been said and done. It's already old news. It's already happened. So, I can't worry about what Warren Buffett is doing. He's got to do his own thing. He has his own objectives and, risk tolerance. And, he might be selling Exxon because he owns too many railroads and he has enough exposure there. I have no idea why he does anything. What he does is not my problem. He has to manage his portfolio for his reasons. I got to do mine for mine. So he's not worried about what I'm doing. So why should I worry about what he's doing?
Okay, so you're not paying much attention to the oil patch, but you are looking at the natural gas, and you are looking at the UNG here, and it looks like we're getting a nice setup here. We've just found a lot of support here. Now getting off a little bit of the support. Is this something you played when it dipped down there? I don't even know if it made a new low there, but give us your setup in the natural gas sector, UNG, and perhaps some other stocks that you're looking at.
Sure. Well, looking specifically at the natural gas futures, remember UNG is an ETF that it's expensive to be in that ETF relative to the futures. But looking at the natural gas futures themselves, I mean, look at these lows right around the January lows right around 272, 273, right? Then we rolled over at the beginning of February, made fresh lows, right? So we quickly recovered back above that last week, which is, we were just talking about the best case scenario in oil, that we make new lows, shake out, all of those bulls trying to bottom fish. We're already seeing that taking place in natural gas. And in addition to that, you have prices from the November highs. Remember, prices in natural gas have gotten, oil gets the attention, but natural gas has been cut in half in 2 months. And I don't hear many people talking about it because they're more obsessed with oil, which is fine by me. I'd rather have them worry about that than that gas. We made new lows at the beginning of February, quickly came back. Now we've taken out the downtrend line from the November highs in natural gas, and momentum is putting in a bullish divergence. So I think we're off to the races. Personally, we're already involved, and I'd like to add to that position. If we start taking out the highs from the last week, call it 289 and change 290, we take that out to the upside. I think we're off to the races. I think we can get a monster squeeze, at the very least see about 330 and realistically maybe 380 to $4 in UNG. That would be, I wouldn't be surprised by a mean reversion at all. And more importantly, the risk is so well defined. I mean, which at the end of the day is the only thing that matters is how well the risk is defined. UNG, I'm looking at it right here, looks exactly the same. New lows at the beginning of February, quick reversal back above the January lows. Now we're making new highs, above 14.5. I mean, that thing is great. So, if you're looking at natural gas, as long as we're above the downtrend line from the November highs, which also happens to be the January lows, as long as we're above that, we can own it all day. Be very aggressively long. Below that, all bets are off. So from a
JC,
risk-reward standpoint, getting back to what we were just talking about, the risk is very well defined, and that to me is the only thing that matters.
so JC, a lot of our traders that listen to the show don't trade futures, don't maybe trade the UNG. They like to trade the individual stocks. Is there any natty gas stocks that you're looking at here, like a Chesapeake or something, or any other ones that you prefer to play if you played it through the equities?
They're just not correlated. There's a common misconception out there that natural gas stocks and natural gas have this high correlation that's just really not there. So for me, if I'm going to be in natural gas, I'm going to be in natural gas. Like, I don't need to get cute and buy a natural gas company that may or may not trade with nat gas, right?
Right. They had a lot of these companies are also in the oil patch and
Yeah, there's a
whatnot.
lot of mix. It's hard to find those pure gas
Uh,
There's
stocks.
no pure play, So
Yeah,
like, why get cute? If you want to be in gold, be in gold. You don't need to buy gold miners,
gotcha.
right? If you want to be in nat gas, buy nat gas. You don't need to buy, right? You see what I'm saying?
Okay, you just mentioned gold here, and you were talking about a mean reversion in gold here at 13,900, held like a charm, back down, dipped under 1,200 yesterday, getting a little bit of a bounce today. Give us your outlook here on gold.
Yeah, my outlook is to continue to stay away from it. I mean, this is, you want to talk about difficult trades. I mean, this is another chop fest. I mean, anybody in this is getting chopped around. I don't care who you are. You look at a chart like this, I mean, it's just so ugly. What I would suggest, and, speaking of high correlations, the easier chart to look at is silver. That's the cleaner chart. Not that it's pretty or anything, it's just cleaner. You look at silver, finding that support throughout 2013 and 2014, right around 18.5, 1860, right? That was major support that broke last September. So we sold off hard, as we should have, when key support is broken, and then rallied right back last month back to that 18.5 level that was support. So our polarity principles teach us that former support, especially something this significant, should turn into resistance on another retest to the upside, and that's what we got. So if you want to be in gold, that's fine, but look at the silver chart, because as long as silver is below all of that support since 2013, 1850, 1860, call it, as long as we're below that, there's no reason to be long, particularly from a structural perspective. As a trader, yeah, you're going to get moves back and forth, especially with silver, because it's the crazy time. But if you're going to be in gold, look at those. A trade that we put on yesterday is junior gold miners. I thought that was super interesting. It's a very short-term trade, which is not typically something that I do, but the risk-reward was just so clean. Look at GDX yesterday reversing at key support. These were the lows in December of 2013 that broke down last fall, and we quickly recovered back above that level in January, and we're retesting that. Call it 20 and change, $20.30, $20.40. So from a risk-reward standpoint, it was a no-brainer. I'll be fading that in, around 22.5, something like that. So it's a very short-term trade. Structurally, this is still a hot mess. So it's not anything that I want to look at bigger picture. But every now and then, you'll get these, very short-term opportunities with very, very well-defined risk, which, getting back to that, again, sticking with that theme, it's if you can define your risk and you know where you're wrong, that's all that matters. And in this case, I know where I'm wrong. It's a very simple trade. It's a nice risk reward. It was about a 7-to-1 risk reward. I'll take that.
We're on the line with JC Parets of Eagle Bay Capital, discussing his strategies in the markets. Real quick, JC, I think it might be a little bit self-explanatory, but you were talking about correlation, between the natural gas stocks and the actual futures. Could you just go over that again real quickly?
Well, remember, just because a company has the name natural gas in it, or perhaps is exposed to natural gas, doesn't mean that the price of the stock is going to move with the price of the commodity, right? Which is if you read enough news articles and you watch TV enough, you'll see a lot of lazy commentary from people that just don't want to do the actual math. And correlation coefficients are this is elementary math, and people just, for whatever reason, choose not to do it. Lately, another interesting example is in crude oil. I'm constantly hearing and reading about how the stock market recovered because crude oil stabilized. That is just they're lying to you. That is just not true. There is no correlation at all between the S&P 500 and crude oil. And anytime you hear anybody telling you that, they're either lying to you or they're just lazy and not doing the math. It is just simply not true. There is no correlation between the S&P 500 and crude oil. Just
Real
like
quickly,
there isn't any
JC.
correlation between natural gas and natural gas stocks. If you like natural gas, buy natural gas. You don't need to buy the stocks. They're two different things.
Okay, in 30 seconds here, just real quick, you were bullish to semiconductors. I'm just pulling up the stocks here. Have you still holding on, or have you hit any of your targets in, let's say, Micron?
Yeah, well, I mean, looking at SMH, for example, we got back up to the December highs, this week. So obviously, when you get up to former highs like this, it'd be irresponsible not to, at least assume that you're going to see some sort of acknowledgement of that overhead supply. And I think we may or may not, but, it's something that we want to keep in mind. I still love the group. I think Micron heads a lot higher. Broadcom is a name that I mentioned last week. Continued after a radio interview, continued to make new highs. I think it still does. I think we're heading back up to those 2011 highs, right around 47.5. Right now, Broadcom's around 45.5. So I think we got another couple of points to the upside here in the near term. I love the group, and you want to know something bigger picture? Strength in semiconductors. It's a great leading indicator for tech as a group. The Nasdaq heavy index, and with that being said, the Nasdaq is not just being led by Apple. I get that it's the biggest component, but look at an equal weighted index of the Nasdaq 100. It's actually doing even better than the Nasdaq 100. That's all Apple. So when you see that broad-based rally led by the biggest company in the world, also led by the leading indicator, which is semiconductors, it's hard to be bearish.
Okay, and just real quickly, overall market here, running into a lot of resistance just under 2100, trying to pull back. Any outlooks here? Finally going to have a correction in the market?
I don't see resistance at 2100. You're saying in the S&P 500? 2100?
I'm looking at the futures. We hit 98.50, 98.75. We hit 99.50 today. Three highs within a point and a half. It looks like pretty good technical resistance on the S&P futures.
Got it. So the last few days, got it. I learned at an early age, don't short a dull market. And correct me if I'm wrong, the last few days have been pretty dull.
Yep. Okay.
I guess I agree with you. I'd be looking at those late December highs. I really don't want to fail up here. I'll say that.
Okay.
As long as prices can remain above those December highs, it's tough to be bearish. It
Okay.
really is.
JC Parets of Eagle Bay Capital joining us here in Benzinga's pre-market prep. Thanks a lot, JC. We'll talk to you again next week.
Thanks for having me, guys.
Okay.
Thanks, JC.
Dennis went a little long there. Got a Walmart update for us?
Well, yeah, Walmart's actually trading red here now. So whoever's buying up there, actually, well, it's down over $1 here now. So this was trading up over $88 ahead of the report. Somebody was gambling that Walmart was just going to blow everything away. They actually reported a pretty good quarter, but it definitely wasn't good enough. And the guidance and the stock is now trading red here. So it's been a wild pre-market range here. What's the pre-market low there, Joe, for Walmart? Just quickly for our traders.
Yeah, the pre-market low here. I think we're making a new low as we speak. Just on the lows, Dennis. We just made a low at 84.75 here, continuing to move lower. That $84 level sticks out. 83.93. That was your low on February 2nd. All right, Dennis, 8:55. We'll let you go. Get ready for that 9 o'clock hour. It's time to go to Brianna with the morning headlines.
Well, it's Thursday, February 19th, and Germany has rejected Greece's request for an extension of its aid program, saying its offer doesn't meet the Euro region's conditions for continuing aid. The Greek government is trying to agree bridge financing without meeting the conditions of its existing rescue program, German's finance ministry spokesman Martin Jaeger said in an emailed statement. European Commission spokesman Margarita Shinas moments earlier had said that the Greek letter could be the basis for a reasonable compromise. The euro dropped 0.3%. The United States Marshals Service announced on Wednesday that it would auction 50,000 bitcoins worth nearly $12 million seized in connection with the online marketplace Silk Road. The Bitcoin auction, to be held on March 5th, comes more than 2 months after the service's second Bitcoin auction in December when it sold 50,000 bitcoins. The latest auction is for Bitcoin seeds from a computer hardware belonging to Ross Ulbricht, who was convicted in federal district court in Manhattan this month on charges related to the operation ownership of Silk Road. The website was shut down in October of 2013 after the authorities said it was an online bazaar for illegal drugs and other illicit activities. Apple has asked its suppliers in Asia to make a combined 5 to 6 million units of its three Apple Watch models during the first quarter ahead of the product's release in April, according to people familiar with the matter. Half of the first quarter production order is earmarked for the entry level Apple Watch Sport model, while the mid tier Apple Watch is expected to account for 1/3 of output, one of the people had said. Orders for the Apple Watch Edition, the high end model featuring 18 karat gold casing, are relatively small in the first quarter, but Apple plans to start producing more than 1 million units per month in the second quarter. Analysts expect demand for the high end watches to be strong in China, where Apple's sales are booming. In other Apple news, electric car battery maker A123 Systems has sued Apple for poaching top engineers to build a large scale battery division, according to a court filing that offered further evidence that the iPhone maker may be developing a car. Apple has been poaching engineers with deep expertise in car systems, including from Tesla, and talking with industry experts and automakers with the ultimate aim of learning how to make its own electric car, an auto industry source said last week. Around June of 2014, Apple began aggressively poaching A123 engineers, with, tasked with leading some of the company's most critical projects, the lawsuit said. The engineers jumped ship to pursue similar programs in Apple in violation of their employment agreements. And Samsung will buy LoopPay, a mobile payments company. LoopPay's technology allows mobile payments through a traditional magnetic credit card readers. That means it can theoretically work in a lot more places than Apple Pay, which requires special payment pads to work. Samsung did not say how much it's paying to buy LoopPay. According to a report last year in Recode, Samsung plans to incorporate LoopPay's technology in an upcoming flagship phone like the Galaxy 6. Just a quick reminder, our show is brought to you by our friends at Nadex, where you can find protection from market spikes and opportunities in flat markets using binary options. Open an account today with no fees and only $100 as your minimum deposit. Tell them your friends at Benzinga sent you. If you missed any part of today's show, you can listen to the whole thing again on our podcast. Find us on iTunes, SoundCloud, and Stitcher by searching hashtag premarket. Joel, it is almost 9 o'clock. Shall we go grab our next guest?
Next guest, Ian Weiner, Director of Equity Trading for Wedbush Securities. We'll be right back with Ian.